let's talk about something that can make or break your financial future, your credit score. It's important to understand what your credit score means and how it works and how to improve it, but that can prove challenging. Fortunately, in this video, I'm going to break down the ins and outs of credit scores, including how they're calculated, what the different ranges mean, and the factors that affect your score. We'll also provide practical tips and strategies to help you improve your credit score and take control of your finances. So, let's dive right in. Welcome back to the channel. I'm Andy from Credit Sage, and we're the go-to guys to help you turn your credit around. With over 3,000 reviews and a 4.9 out of 5 Trustpilot rating, you can trust that we have the knowledge and expertise to guide you through the credit building process. Now today, I'm excited to share some vital information that can take your credit game to the next level. But first, let's begin with the basics. What even is credit? We hear it talked about all the time, but what is it? Well, credit refers to the borrowing of money or the ability to purchase goods or services with the promise of paying for them later. When you use credit, you are essentially borrowing money from a lender, such as a bank or credit union or credit card company, with the agreement that you will pay the money back, usually with a little bit of interest. Now, there are different types of credit. Installment loans, for example, such as car loans or mortgages, which involve borrowing a set amount of money and paying it back over some time with fixed payments. Or revolving credit, such as credit cards, which allow you to borrow up to a certain limit and make payments based on the amount you used. Credit scores are numerical representations of your credit worthiness based on your credit history. Lenders use them to evaluate your credit risk to determine whether to approve your loan or credit card application and what interest rate and terms to offer you. Now, these scores are calculated by credit reporting agencies such as Equifax, Experian, and TransUnion based on your credit history. The most commonly used scoring model is FICO score, which ranges from 300 to 850, with higher scores indicating better credit worthiness. So I'll break down the general categories of credit scores for you here. If your credit score is between 800 and 850, it's considered excellent. A credit score ranging from 740 to 799 is categorized as very good. A credit score between 670 and 739 falls into the good category, and you're on fair grounds with a credit score between 580 and 669. But if you're between scores 300 and 579, it's considered poor. If you're curious about what goes into credit score formula, well, here's what you need to know. Your payment history takes the cake, accounting for 35% of your score. This reflects whether you make your payments on time and your consistency. Credit utilization comes in at a close second, as it makes up 30% of your score and points to how much of your available credit you're using. The length of your credit history accounts for 15% of your score and is based on how long you've been using credit. Now, new credit takes up 10% of your score and reflects how often you apply for new credit. Finally, the types of credit you have make up the remaining 10% of your score and is dependent on the different types of credit you use. So, why do credit scores matter? Well, as I said earlier, credit scores are used by lenders and other financial institutions to evaluate your credit worthiness and determine whether to approve you for a loan or credit card application, and again, what interest rate and terms they're going to offer you, which are going to affect your monthly payments or overall payment. A good credit score can make it easier for you to get approved for loans and credit cards with favorable interest rates and terms, which can save you money in the long run. On the other hand, a poor credit score can make it difficult to get approved for credit and may result in a higher interest rate and fees. This can make it harder for you to get the financing that you need, and can also lead to higher costs over the time of the loan. In addition to impacting your ability to get approved for credit, your credit score can also be used by landlords, employers, and insurance companies to take a look and evaluate your reliability and trustworthiness. It crosses over into various parts of your life. So whether you want credit or not, it's a part of your life. So let me paint a clear picture for you. Imagine that you're in the market for a new car and you need to borrow $20,000 to make the purchase. You apply for a car loan and the lender looks at your credit score to determine whether to approve your application and what interest rate to offer you. If you have a good credit score, say around 750, the lender may offer you a loan with an interest rate of 4%, which will result in a monthly payment of $368 over a 5-year loan term. However, if your credit score is on the poor side, say around 500, the lender may only offer you a loan with an interest rate of 15%, which will result in a monthly payment of $472 over the same loan term. As you can see, the difference in interest rates can result in a much higher monthly payment and total cost over the life of the loan. In this case, the higher interest rate on the poor credit score would result in an extra $4,320 in interest over the course of the 5 years of the loan. So you can see why you want to aim high with your credit scores, whether you're looking to give a boost to an okay score or rebuild after setbacks. Here's how to go about it. The first step is to remove errors from your report. The reason is stuff like this, inaccuracies and false or outdated information that is negative items, can weigh down your credit significantly. The more severe the item, the worse the impact. So it's essential that you get rid of them. The best way to do this is to contact Credit Sage. No need to stress over your credit score when you can trust our team of experts to handle this for you. We have the expertise to identify possible issues and tackle each one, potentially raising your score. So just contact us today using the number in the description below, and we'll take care of everything from there. Now, on the other hand, if you prefer to handle it yourself, here are a few steps that you can follow right away. First is you want to obtain a copy of your credit report. And you can do this for free once a year from each of the 3 credit reporting agencies. Just head to annualcreditreport.com to get this done. Once you've gotten your reports, review them carefully for errors, which you can then dispute with the credit bureaus. Another easy thing is pay your bills on time. We already established how big of a role the history of your payment history is in calculating your credit score. So late payments can have significant negative impacts on your score. So it's crucial to make all your payments on time every time. Set up automatic payments or reminders to help you stay on track of this. You also want to reduce your credit card balances. Credit utilization is another critical factor in determining your credit score. Aim to keep your credit card balances at or below 30% of your total credit limit. For example, if you have a credit limit of $10,000, try to keep your balances below $3,000. High credit card balances can signal to lenders that you're relying too heavily on credit, which can negatively impact your credit score. And if possible, pay off your balances in full each month to avoid interest charges at all. Avoid new credit applications. Every time you apply for credit, it can have a temporary negative impact on your credit score. Only apply for credit when you need it, and avoid opening multiple new accounts at once. Also, while talking about accounts, keep old accounts open. As I explained earlier, the lenders are looking at your credit history to assess your eligibility. So keeping old accounts open, even if you don't use them, can help improve your credit score. And at the same time, closing old credit accounts can hurt your score by shortening your credit history. And you want to build a good quality credit history. A longer credit history can positively impact your credit score. If you don't have much credit history, consider opening a secured credit card or becoming an authorized user on someone else's credit card. A credit builder loan can also help you out with this. These loans are designed to help you build credit by making small monthly payments. And as you make these payments, the lender reports your payments to the credit bureaus, which can help improve your credit score. And remember, you have to approach these steps with a long-term mindset. Building a strong credit history takes time and consistent effort. But don't worry, if it starts to feel overwhelmed, you can always circle back to option 1 and let Credit Sage take care of everything for you. With a quick phone consultation, you can sign up for our services and get started on improving your credit score today. Now, if you found this video at all helpful, please show your support by hitting the like and subscribe button to our channel for new videos each and every week. Thanks for watching.